Hey, hi everyone. Welcome to another video in our public policy and political economy series. And today's video is a hypothetical situation. We're going to discuss about a hypothetical situation, and in that hypothetical situation, if that happens, and this is just hypothetical, it's not going to happen. But if it happens, what would happen is the scenario, and we have taken help of ChatGPT to analyze this particular scenario. Okay, so the scenario is if India were to adopt the US dollar as the main currency instead of Indian rupee and print money similar to USA and lend money to business at zero or less than 0.5% interest rate or 1% interest rate per year. Okay, how will that change the Indian economy, and how will different industries and sectors get impacted, and will country progress because of this, and will this improve the GDP, okay, and job market, and will this reduce unemployment in the country? Mainly if India wanted to become an economy less reliant on exports and more reliant on domestic demand, how will this policy change affect the Indian economy? And this is just hypothetical situation. Okay, this is not real, and we are taking ChatGPT's help to analyze it. Okay, it's a nice thought experiment. That's what it says, ChatGPT. So it gets to the heart of macro policy, monetary sovereignty, and trade dynamics. But yeah, it's saying I'm blunt upfront. India can't realistically print US dollars like the USA. US issues USD. Other countries can dollarize, use the dollar as a legal tender, or peg their currency to it, but they can't issue dollars on their own. Okay, that's what it says. So you can peg your currency to dollar, or you can use dollar as a legal tender, but you can't print the dollars or issue dollars on your own. With that constraint clear, I'll cover two parts. While adopting the US dollar, fully dollarization really what this fully dollarization or adapting the US dollar really mean in practice, and why India can't print USD unilaterally. If India somehow cheaply borrows or obtains abundant USD funding and lends domestically at 0 to 0.5% interest rate, what would it be the likely macroeconomic, sectoral, and labor market effects, short run and as well as in the long run? How it will affect export and domestic demand? So the key reality is you can't just print USD. Only the US Treasury and Fed Reserve creates USD. No sovereign country outside the US can lawfully print USD. A country can adopt a dollar like Ecuador and Panama has done, or run a currency board or peg, but it must obtain USD by running surpluses or borrowing, attracting capital inflows, or holding reserves. Okay, so if you adopt USD, you can't print it, and only thing you could do is you could borrow it, or you could have surpluses or attract capital inflows or hold reserves. So if India adopted the full dollarization, RBI would lose control of monetary policy and seigniorage, the profit from issuing currency. Interest rates, money supply, and lender of last resort functions would be constrained by available USD liquidity, and Fed policy transmission indirectly through market rates and capital flows. So RBI will lose control of monetary policy, and the profit from issuing currency, interest rates control it will lose, supply of money also it will lose, and lender of last resort also it will be lost, and it will all go to Fed. It will all depend on USD liquidity and Fed policy transmission. Okay, then if India somehow had access to unlimited USD funding, which is hypothetical situation, then lending domestically at near zero would be possible only as long as funding remains cheap and capital flows are stable. That assumption is very strong and fragile. So the rest of the answer treats the user scenario as hypothetical. India gets large USD funding and lends domestically at 0 to 0.5% and ask what follows. Okay. So this is a hypothetical situation. We are just analyzing something. If this happens, what happens? Okay, it's not realistic situation. The short summary likely affects big pictures. In the short run, there will be a big boost to the domestic demand, consumption, and investment because of lower borrowing costs, and housing durable goods will boom. Strong credit expansion will happen, and real GDP rise will happen, and unemployment will fall. Okay, medium term, large import surge will happen, and trade current account deterioration will happen. Inflationary pressure will be there. Imported demand meets supply constraints, and stress on balance of payments will be there. Currency or sovereign risk also will be there if USD funding tightens. Competitiveness will worsen because you remove nominal depreciation as a tool. Long run, unless supply side capacity expands, productivity, infrastructure, manufacturing scales up, stimulus leads to inflation, asset bubbles, and possibly a debt or FX crisis if foreign funding dries up. Structural shift towards domestic demand is possible but not guaranteed. So that's what it says. In the short term it will be useful, but in the long term, you will have problems. That's what it says. Transmission channels, how cheap USD funding domestic economy. If cheap USD funding is available for banks and firms, they can lend at 0.5%. That will have lower cost of capital. So firms find it their projects which are marginal to be profitable now. Capex rises like real estate, infrastructure, and factories. Okay, consumer borrowing will become cheap. Mortgage and consumer credit will expand. Consumption of housing, automobiles, durables will rise. Government borrows cheaply. If government can access USD, possible fiscal stimulus on infrastructure and transfers could happen. Exchange rate channel. If India uses USD as a currency or pegs tightly, there is no rupee depreciation buffer. Prices of imports become stable in USD terms, but domestic currency cannot devalue to restore competitiveness. Capital flows. Abundant cheap capital encourages import of capital goods, tech, and consumer durable imports. Portfolio flows can drive asset prices up. Bank profitability and structure. Banks earning net interest margin will get compressed. They must do higher volumes or fee businesses. Some banks dependent on spread may suffer unless subsidized by the government. Sector by sector impacts. So banking and financial sector, credit demand will skyrocket. Loan books will grow. Fees from mortgages, consumer loans, and financial will deepen. But risks are margin compression will happen unless funded cheap or lent higher. Maturity mismatch will happen, and credit risk if underwriting weak or asset price bubbles are there. Higher household leverage is there. If lending at near zero, banks must find other ways income sources. Viability of banks with heavy fixed costs could be strained unless government supports them. Systemic risk will be there. Rapid credit growth without prudent underwriting, risking non-performing loans later. Okay, so systemic risk will be there. Banking sector will find problems uh, to sustain themselves. But yeah, credit demand will skyrocket, loan books will grow, and so on. Real estate and construction, there will be boom in real estate. Mortgage affordability increases, prices will climb, construction activity surges, employment in construction will rise, but bubble risk will be there. Property bubble or eventually painful correction risk will be there. Consumer durables and autos surge will be there as loans are cheaper now. Domestic manufacturing ramps up. So if local supply exists, otherwise imports will increase. Manufacturing domestic oriented, potential positive. Cheap capital will finance capacity expansion, automation, factory upgrades, and supports the domestic demand pivot. But if imports, machinery components are imported, manufacturing may run trade deficits and become dependent on imports. Competitiveness versus imports may suffer if domestic costs rise with inflation. Export and trade exposed industries, these will have a negative impact. Strong domestic demand, you know, and no currency depreciation tool and cheaper imports. Okay, so exports could stagnate or decline. Exporters can't rely on currency adjustments to stay competitive. They must improve productivity or reduce costs. Adverse effects on sectors reliant on price competitiveness, like textiles, labor intensive manufacturing, these will have an adverse effect unless offset by productivity gains. Agriculture and rural economy, this will have a mixed thing. Higher rural demand will support agri demand and rural wages, but input inflation and commodity import competition could be harmful. And cheap credit aimed at agri-tech and irrigation could boost productivity. Middle and small medium enterprises, opportunity. Cheap working capital would help many MSMEs expand, invest in machinery, and higher risk. If banks channel credit mainly to larger firms, MSMEs can be left out. Also, competition from imported goods if domestic protection lowers. Okay, infrastructure and public works, immediate positive. Public investment financed cheaply, roads, power, ports, housing. This all will have an immediate positive. This supports employment and raises supply chain capacity. Crucial to avoid inflation. Services, retail, construction, IT, hospitality will boost from higher consumption. Domestic consumption, tourism, and hospitality will recover. Retail will expand. Macro consequences: inflation, trade, fiscal, and external balances. Inflation, so demand pull inflation. Unlike likely, pull inflation will happen unless supply responds quickly. So India has structural bottlenecks like logistics, power, and skilled labor. Without resolving this, price increases will follow demand expansion. Imported inflation risk depends on USD price movements. But cheap USD funding itself is not inflationary unless it increases money spending power in India. So there is a demand pull inflation can happen. Current account and FX imports surge for capital goods and consumer goods. So current account deficit increases unless exports rise commensurately. So if India is dollarized, FX reserves and external access will matter. Deficit must be financed by foreign capital inflows. If those inflows stop, crisis risk arises. Fiscal policy and debt. If government borrows in USD or gets cheap funding, fiscal space opens, but long-term debt service depends on ability to refinance and maintain investor confidence. If bonds are in USD, sovereign is exposed to changes in global rates. Monetary policy, dollarization removes independent monetary policy. India cannot set rates to control inflation. It's subject to US policy and market rates for USD. If India tries to maintain lower domestic lending rates while US rates rise, capital flight or reserve drain can occur. Employment and GDP, will jobs and GDP improve? Short term, yes, GDP will improve due to higher consumption and investment. Employment will rise, especially in construction, retail, services, and manufacturing. Unemployment will fall. Medium to long term, conditional, sustainable GDP and job gains require supply side response also. So, if enough investment is there to increase productive capacity like power, logistics, land, labor skills, and this GDP and job gains will sustain. Manufacturing competitiveness improvements, productivity, technology improvements if they are there to avoid being swamped by imports. So we ourselves produce things, so that would be really good instead of swamped by imports. Financial stability, avoid asset bubbles and banking crisis. These conditions fail. Manufacturing competitiveness is not there, or financial stability is not there, supply side response is not there. The initial boom that is followed, will have inflation, currency, financial stress, and job losses in the sectors. And the net employment gains could be smaller or reversed. Impact on the policy goal, be less reliant on exports and more on domestic demand. This stimulus to domestic demand is very effective in the short run, consumption-led growth, but making growth sustainable, domestic demand-led requires a structural change. So build domestic supply chains so that rising demand is satisfied by domestic firms, not imports. Skills, logistics, manufacturing investment so industries can meet domestic demand with competitive local production, support MSMEs, improve ease of doing business, and incentivize local procurement. Dollarization plus cheap USD can kick start demand but doesn't automatically build domestic productive capacity. Without targeted industrial policy and supply side reforms, domestic demand expansion may primarily fuel imports, worsening trade balance and hurting domestic manufacturing. Risk and failure, why the policy can go wrong. Loss of monetary sovereignty, that is a big risk. You cannot respond to domestic inflation with interest rate hikes or liquidity management. Balance of payment crisis can happen if foreign financing conditions change or if imports explode. You cannot devalue to restore competitiveness. Asset bubbles risk could be there. Real estate equities from cheap credit, painful corrections can happen. Banking sector fragility will be there if underwriting stands slip and NLPs will rise. Inequalities for credit-driven booms often benefit asset owners first, real estate and well-connected firms, possible increasing inequality unless targeted. Export competitiveness loss will be there. So sectors running on price advantage will suffer, producing structural unemployment unless workers are reabsorbed. So practical policy alternatives to reach the same goal, which is more domestic consumption and less reliant on exports, is the same goal, but less risky approach is this one. The aim is to increase domestic demand and reduce export reliance and generate jobs. Consider these safe and feasible levers. So, target credit programs, low cost loans for MSMEs, manufacturing, capex, and housing with strict underwriting rather than blanket near zero rates. Okay, so credit programs with low cost loans. And public investment should be done in infrastructure, roads, ports, power, urban amenities, financed prudently. This raises supply capacity and crowds in private capex. Sectoral incentives could be given to build domestic supply chains, like subsidies, tax breaks tied to local content. Labor skilling and education could be done to absorb workers into higher productivity jobs. Improve ease of doing business and reduces logistics costs to make domestic production competitive. Monetary policy easing when prudent, but preserving central bank independence and inflation targeting. Selective tariffs or a temporary import safeguards to give infant domestic industry space while they scale, used with care to avoid trade wars. So tariffs, okay, and import safeguards also could be done. And credit guarantees and risk sharing to get the banks to lend to underbanked sectors without under sacrificing prudence. So these less risky approach could be done to achieve domestic demand-led transition without the macro risks of dollarization or whole foreign currency printing. Bottom line, adapting a USD and printing USD like the USC is not possible for India. Dollarization would surrender monetary control and seigniorage, and printing USD is impossible. Unlimited cheap USD funding to 0 or 0.5% domestic lending would produce a powerful short-term boom. Higher GDP, lower unemployment initially, but would very likely produce large import-led deficits, inflation, asset bubbles, and vulnerability to sudden stops in foreign funding. Export competitiveness also would worsen, not improve. Okay. So if India's objective is to shift its strong domestic-led growth, the right policy mix is to target cheap credit, strong public investment, supply-side reforms, and institutional improvements, not dollarization or relying on foreign currency prints. So that's the topic, guys. So it's a hypothetical scenario, but we analyzed it, how it impacts if it is done. That's it for today. Thanks, everyone. Have a nice day. Bye.